Credit Suisse, one of the largest banks in the world, is having major financial problems. Earlier today, they announced that they expect to lose up to $1.6 billion, this billion with a B, in the fourth quarter of 2022 alone because rich people are pulling their money out of Credit Suisse, and this could indicate some bigger issues in the banking industry. And second, today we got our weekly jobless claims numbers a day early. Typically they come out on Thursday, but tomorrow's Thanksgiving, so they released them a day early. And what it said is that there were more jobless claims than expected this week, but not that many more. But it did give us an indication of what these layoffs might be doing to the jobs market. So let's jump right in. Today is Wednesday, November 23rd, and the power is out in my office today, which is why it is dark here. And just so you know, tomorrow there's not going to be a midday recap because the markets are closed on Thanksgiving. And on Friday, I will also not have a midday recap because we have a big giving back community service event. So I will not be able to record a midday recap on Friday either. But jumping into things for today, Credit Suisse, one of the largest banks in the world, announced that they are losing a lot of money. They announced that they can lose up to $1.6 billion in just the fourth quarter of 2022 alone. And the reason why, not just because rich people are leaving, but also because of economic conditions and because of market environments. AKA, they're saying that because the economy, the global economy is slowing down, and because of high inflation, and because of the rising interest rates, it's making it very difficult for them to sustain their profits and also keep their customers. So while they're worried about the market conditions, you have a bunch of rich people that have millions, if not billions of dollars at Credit Suisse pulling a big chunk of their cash out. They saw about 6% of their total assets leave in the recent months from Credit Suisse because people are worried about the health of Credit Suisse. Now again, this is one of the largest banks in the world, so this is definitely something you want to pay attention to. And it got so bad that Credit Suisse was forced to dip into their liquidity buffers, meaning that they had less cash on hand than is required by the regulatory agencies. So every investment and banking institution is required to keep some cash in reserves. And this is just in case something bad were to happen. So if everybody goes to pull their money out, that the banks and institutions have some cash there to make sure they have cash to fund people pulling their money out. Well, Credit Suisse saw such a large outflow of money that they dipped below what is required in terms of reserves. So today, Wednesday, they held an emergency meeting on what they need to do and how they can raise more capital funds, how they can raise more cash as an emergency, kind of like a savings fund in case things continue to get worse. And this morning, what they announced is that they're going to offer more shares at a diluted price. That way they can raise about $4.2 billion. So what that means is they're going to offer more of their stock at a discount. So people want to invest in the company and give them company, but they get to buy shares at a discounted price. That way they can quickly raise this cash to not only meet these regulatory reserves again, but then also have some extra cash because now that this news is breaking out about Credit Suisse's health, well, you can bet that that's going to make more people worried about their cash and investments in Credit Suisse. It will cause a bigger outflow of cash. And so that is the worries there. And it does pose questions and concerns about the rest of the banking sector. I mean, if Credit Suisse is facing all these troubles, now of course, Credit Suisse did have a lot of scandals, which cost them a lot of money. They ran into a lot of issues over the last number of years, which did cost them a lot of money. But the economic conditions that Credit Suisse is facing, meaning higher interest rates, high inflation, and a slowing economy, that's not just Credit Suisse. That's everybody in every institution. Now, of course, some institutions are better capitalized, they have more reserves, and they're better poised to take advantage of opportunities. But you can bet that they're not the only institution struggling because of what's happening right now. And we haven't really seen the full effects of the downturn of the economy or the effects of the higher interest rates. I mean, interest rates are not done going up. We're going to see interest rates go up again in December. We're going to see interest rates continue to go up into 2023. And we haven't felt the absorption of the higher interest rates that we have now. So you can expect more and more banking institutions to start to struggle because of what's happening. I mean, Credit Suisse is just one company that's starting to struggle. So this is something you want to pay attention to, and definitely a good time to make sure your investments in cash are somewhere safe, because there's just a lot of craziness happening in the economy, and the effects of the higher interest rates are going to trickle down into many different parts of the economy, and it's going to be felt by many different businesses in many different sectors. And so this is where you have to be smart with your money and understand, one, that these downturns can create more opportunities than any other time, but you have to make sure that your money is safe and protected. Make sure you're keeping it somewhere where you have access to the cash, and just understanding that, if you see these types of red flags happening, then be smarter with your money. Just pay attention to what's happening. That way you can make sure your money is protected, because there's a lot of craziness happening, and it looks like it's going to continue to get worse into 2023, which brings me to the jobs report, because the jobs report this week came in a little bit worse than expected, meaning more people applied for unemployment benefits. More people said that they no longer have a job than what was expected. Well, when you read the statements and you read economists' reports on what this means, essentially what every economist said is, this is nothing to worry about. It's just an outlier. Yeah, we got some layoffs in the tech sector, but it's not going to bleed into other sectors. This is like the common consensus amongst economists everywhere. But again, you got to be smart here. Let's just back up a little bit. Remember, the same people said, inflation is not going to happen in 2020. They then said inflation is transitory in 2021. They then said a recession is impossible in 2022. Well, just pay attention to what's happening, because all these things can build on top of one another. And if interest rates continue to rise, like the Federal Reserve Bank says that they are, that is going to put more pressure on businesses to cut costs. How do you cut costs as a business? Well, one of the ways to do that is by doing layoffs. If you continue to see more layoffs, more people lose jobs, less people are going to have the ability to pay their bills. You lose your job, it's going to be harder for you to pay a mortgage. It's going to be harder for you to pay your car payment. We've already seen car repossessions start to rise in the second half of 2022. Why? Because people are struggling. People would much rather let go of their car than they would their house. And these are things that if people don't make their car payments, well, then car companies start to get hurt. If they don't make their housing payments, then lenders start to get hurt. And you have to understand that the economy is completely intertwined. And unlike previous recessions, unlike 2020, 2008, 2001, we did not have an inflation problem in the previous economic slowdowns. Now we do. In the previous economic slowdowns, when the economy slowed down, the Federal Reserve Bank was able to cut interest rates, they were able to print money, and they were able to do stimulus, because all these things create more inflation and they help stimulate the economy. We don't have the same ability to do that now without causing more harm to the economy. Because if we continue to see an economic slowdown, more people lose their jobs, we see more pain in different sectors of the economy, because right now you have a lot of people saying that the pain is going to be contained to the tech sector. Well, if they're wrong, which they're probably going to be wrong if things continue the way that they are, because many companies will get hurt, that's going to hurt more people. And the Federal Reserve Bank is not going to have the same ability to stimulate without causing more harm to the economy, because if the Fed starts cutting interest rates, if they start stimulating, all these things then create more inflation, which then hurts the economy even more, because the economy started to slow down because of all the high inflation. So this is why you need to be paying attention to what's happening around you. That way you can make smart decisions and be financially educated, because, well, the reality is economic slowdowns create more opportunity than any other time. This is not the first time we've seen anything like this happen. We will get through this, and this is why you want to make sure you have the education and the capital to not just survive, but thrive through whatever's happening. I mean, if I'm wrong and nothing bad happens and you're prepared, well, you have some extra cash in the bank and I can go to Disney World. Big deal. But if things do slow down, like the concerns that everyone's talking about, that I'm talking about, and you're not prepared, well, that's a much bigger problem. So I'd rather you be prepared and nothing bad happen than not be prepared and something bad happen. This is what financial education is all about. That way you don't just survive, but you can thrive through whatever happens in the economy. And of course, we keep you updated on Market Briefs, my free financial newsletter. If you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below.